Your mortgage interest rate is a big deal. It decides how much your home truly costs you. A lower rate saves you money over many years. Even a tiny difference in that rate matters. A quarter or 0.5% can mean thousands of dollars. This is your hard-earned money. Let me tell you about Sarah and Tom. They both bought similar homes. Sarah shopped for her mortgage rate. Tom did not. Sarah's rate was just 0.5% lower than Tom's. Over 30 years, Sarah saved over $30,000. Tom paid extra. Securing a good mortgage interest rate is vital. It impacts your future security and peace of mind. This is one of the biggest financial decisions you will ever make. So, you must get it right. Knowledge is your greatest power here. Use it. You cannot just take the first mortgage offer you get. Different lenders offer different rates and terms. Banks, credit unions, online lenders all compete for your business. This competition can save you serious money. It is crucial to shop around. Do not assume your personal bank will give you the best deal. Think of it like buying a car. You would compare prices, features, and financing. Your mortgage is far more significant than a car. Treat it with that level of seriousness. I knew a young man, David. He trusted his bank and almost signed, but his fiancée told him to shop around. He got 3 more quotes. One lender offered a rate 0.75% lower. That saved them thousands. Get multiple loan estimates. Aim for at least 3 to 5. The potential savings are enormous. Be a smart consumer. Your future self will thank you for it. The interest rate is important, yes, but it is not the only number you need to look at. There is something called the APR, annual percentage rate. This APR includes the interest rate, but it also includes many lender fees and other costs associated with your loan. So the APR often gives a truer picture. It shows the overall cost of borrowing. Lenders charge various fees. There are origination fees for processing the loan. There are appraisal fees to value the home. There might be underwriting fees, title fees, and more. These fees can add up to thousands of dollars. If you only focus on the interest rate, you can be misled. A low advertised rate might hide high fees. This makes the loan more expensive overall. Always ask for a full breakdown of fees. When you get loan estimates from different lenders, compare them carefully. Look at Section A, origination charges. Look at the services you can shop for, and the services you cannot shop for. Compare the APR, not just the interest rate. Ask questions. Understand every single charge. If a lender cannot explain a fee clearly, that is a red flag. You are in control. Be an informed borrower. It is your money. Let's talk about your down payment. This is the money you pay up front for your home. The more you put down, the less you need to borrow. A larger down payment can significantly improve your loan terms. It shows the lender you are financially responsible. A higher down payment often means a lower interest rate. If you put down 20% or more, you usually avoid PMI. PMI is private mortgage insurance. It is an extra monthly cost you want to avoid. Saving for a larger down payment takes discipline, but the long-term benefits are huge. Think about Maya. She saved aggressively for 2 more years. She put down 20%. She got a better interest rate than her friends, and she had no PMI payment each month. Her monthly housing cost was much lower. So, how much should you put down? The traditional 20% is ideal to avoid PMI. But if you cannot reach 20%, put down as much as you can. Every extra dollar you put down reduces your loan amount. It saves you interest over the life of the loan. Explore down payment assistance programs too, but always strive to contribute as much as you comfortably can. Your future financial self will thank you. Your credit score is your financial report card. It tells lenders how well you manage debt. It shows your history of paying bills on time. It reflects how much debt you carry. Lenders use this score to decide if they will lend you money, and very importantly, at what interest rate. A higher credit score means you are seen as less risky. Less risk for the lender means a lower rate for you. A strong credit score can save you tens of thousands of dollars. Someone with a 760 score will get a much better rate than someone with a 620 score. Even a small improvement in your score can make a difference. This is not something to ignore. This is something to actively manage. Your credit score is a key to affordable homeownership. So how can you improve your credit score? First, pay all your bills on time, every time. Payment history is the biggest factor. Second, reduce your credit card debt. Try to keep your credit utilization low. Below 30% of your limit is a good target. Third, check your credit report regularly. Dispute any errors you find. Let me tell you about Mark. Mark dreamed of owning a home, but his credit score was not great. He decided to wait 6 months. He paid down his credit cards. His score went up to 720. He got a new quote. The rate was a full % lower. That discipline saved him a fortune. There are different types of mortgage loans. You need to understand the basics. The most common is a fixed-rate mortgage. With this, your interest rate stays the same. For the entire loan term, maybe 15 or 30 years. Your principal and interest payment is predictable. This offers stability and peace of mind. Many people prefer this. I often recommend it, especially for first-time home buyers. Then there are adjustable rate mortgages, or ARMs. With an ARM, the interest rate is fixed for an initial period, maybe 3, 5, 7, or 10 years. After that, the rate can change. It can go up or down based on market conditions. This means your monthly payment can change. ARMs might offer a lower initial rate, but they come with more risk. You must understand that risk. There are also government-insured loans. FHA loans are popular with first-time buyers. They often have lower down payment requirements and more flexible credit criteria. VA loans are for eligible veterans and active military. These can be fantastic, often with no down payment. USDA loans are for eligible rural and suburban home buyers. These also offer no down payment options. Each loan type has its own rules and rates. Choosing the right loan type is critical. It affects your interest rate, it affects your monthly payment, it affects your overall loan cost. Consider your financial situation. Consider how long you plan to stay in the home. Consider your risk tolerance. If you are unsure, talk to a trusted mortgage professional, someone who will explain all options clearly. Not just sell you something. You need education. Get pre-qualified for a mortgage. Better yet, get pre-approved. What is pre-qualification? It is an initial estimate from a lender. They look at your income, your debts, your assets. They give you an idea of how much you might be able to borrow, and at what potential interest rate. This is a crucial first step. It sets realistic expectations. Pre-approval is a more formal step. The lender verifies your financial information. They will pull your credit report. If you meet their criteria, they issue a pre-approval letter. This letter states the loan amount they are willing to lend, subject to certain conditions like an appraisal. This is a powerful tool. It shows sellers you are a serious, credible buyer. It gives you an edge in a competitive market. Imagine you find your dream home. You want to make an offer quickly. If you are not pre-approved, you might lose out. Another buyer, who is pre-approved, could swoop in. Sellers prefer offers from pre-approved buyers. It means the deal is more likely to close. And close faster. Being pre-approved means you can act fast. You know how much you can afford. This reduces stress in the home buying process. So, talk to a lender early, even months before you plan to buy. This gives you time to address any issues. Maybe you need to improve your credit score, or save a bit more for a down payment. Getting pre-qualified helps you understand your budget. It helps you focus your home search. It is about being prepared. It is about being a smart, strategic home buyer. This is non-negotiable for success. We have covered a lot today. The importance of your interest rate, shopping for lenders, understanding APR and fees, the power of a down payment, the impact of your credit score, choosing the right loan type, getting pre-qualified. These are the building blocks, the keys to mastering your mortgage. This knowledge empowers you. It puts you in the driver's seat of your financial future. You can do this. Securing the best possible mortgage rate is not luck. It is about strategy. It is about preparation. It is about asking the right questions. It is about not settling. You work hard for your money. You deserve to keep as much of it as possible. A lower interest rate means lower monthly payments. It means less interest paid over the life of the loan. That means more money for your other goals, for savings, for investments, for your family. Do not be intimidated by the mortgage process. Yes, there are many details, but you can break it down step by step. Use the information you have learned. Be proactive, be diligent, compare offers, negotiate. Remember, lenders want your business. You have more power than you think. This is your journey to homeownership. Take control of it. Owning a home can provide stability, security, and pride. But it must be done responsibly. It must be done smartly. By understanding and securing the best mortgage rate, you are doing just that. You are making a sound financial decision. You are setting yourself up for long-term success. So go out there with confidence. Own your rate, own your home, and own your future. You are approved for a smart financial life.